if you look at, central banks and I guess the end of what they can do, what comes afterwards, and what does that mean for bonds?
I do think fiscal policy has to be used more. And look, I'm at heart, I'm a creative destruction guy, so debt that's too big should collapse. But I think we've built a system that is too reliant on debt, and therefore, if it does collapse, we have a big problem in the economy. So therefore, you probably have to try to reflate into that debt. And as far as I can see, the only way you can do that is probably to use fiscal policy and then have monetary policy support that. So for the rest of my career, I think nominal yields will be below nominal GDP to try to support that.
But who has the fiscal space to do it?
Well, when you've got a fiat money system and central banks can print unlimited money in theory, then every country has a space. I'm not saying it's a good idea economically, but I think it's inevitable that that's the way we go.
Well, okay, that's inevitable where we go. Jim Reid, what does it mean for the rate market? In the year forward, am I going to clip a coupon, or am I going to get the shock of the total return we saw this year, particularly in longer maturity paper?
I'm hoping we ran out of time before I had to answer that, but if you put me on the spot...
We accommodate that on surveillance only because it's Thanksgiving.
Yeah. Look, as I said earlier, I don't think you're going to get a major policy move before the next downturn. So anybody that wants fiscal spending in a hurry is going to be frustrated. So I think rates stay in this sort of channel until you get a downturn. Then rates go lower, and then fiscal spending goes higher, and eventually rates go higher. So I don't believe you're in a low yield environment forever, but I think you'll need a downturn or a crisis to change policy responses to get us out of this low yield environment.